Hey bosses, welcome back to my channel. My name is Jevaux and I'm a real estate agent and developer here in South Florida. And today we are going to talk about news. I'm going to start doing this every week, talking about the most important news in real estate. And I am going to do it while I drink a beer. Not a good beer opener, but I'm a good beer drinker. This video is not sponsored. In real estate, there is a lot of things going on. Interest rates are high, inflation is high, inventory is low, and people are afraid of recession. And last week, we have a news from fortherealtors.gov that says, despite inflation, sinking stocks, and Fed moves, most economists say consumers, the primary driver of the economy, are still spending money at a healthy pace. Meaning, people still have money. The unemployment rate is low and people have job and they are getting paid very well and they are spending their money. The inflation is a 40-year high, stock prices are sinking, and the Federal Reserve is making borrowing money much costlier. And the economy actually shrunk in the first 3 months of the year, says this piece of news. In the United States, at risk of enduring another recession just 2 years after emerging from the last one. Well, the last one was caused by COVID. It was a recession technically, but we know what's caused by. People were just at home not working. For now, most economists, I'm an economist, don't foresee a downturn in the near future. Despite the inflation squeeze, consumers, the primary driver of the economy, are still spending at a healthy pace. Businesses are investing in equipment and software, reflecting a positive outlook, and the job market is still booming with hiring strong, layoffs low, and many employers eager for more workers. Try to hire someone right now. Try to hire someone right at this moment. Either you're going to pay a high price or you're not going to find anybody. That's why there's a lot of people doing virtual assistant outside of the country. Quote, nothing in the US data is currently suggesting a recession is imminent, end quote, said Rubila Faruqi, I think that is, chief US economist at High Frequency Economics, wrote Tuesday. Job growth remains strong and households are still spending. When you have an economy like the US, where the government is not the biggest player on the economy like other ones such as China, Brazil, and stuff like that, if people are spending money, that's a good thing. Among the signs of recession risks are rising. High inflation has proved far more entrenched and persistent than many economists and the Fed had expected. Consumer price rose 8.6% last month from a year earlier, meaning between May and May, prices in average went up 8.6%, the biggest annual 12-month jump since 1981. I was born in 1984. Russia's invasion of Ukraine has exacerbated global food and energy prices. Extreme lockdowns in China over COVID worsened supply shortage. Of course, everything is outsourced in China. If they lock down, prices are going to go up. Fed Chair Jerome Powell has vowed to do whatever it takes to curb inflation, including raising interest rates so high as to weaken the economy. That's how it works. Inflation is a monetary event, meaning a lot of money doesn't worth anything, prices go up. So what the government do to retract that, they incentivize people to spend less. How? Giving them a price. If they increase the interest rates, they can make more money investing in bonds, and also because it's harder or more expensive to borrow money, people just spend less money. If that happens, the Fed could potentially trigger a recession, perhaps in the second half of next year. Second half of next year. So why are you going to wait to make a move now? If the recession is in 2 years, you need to start planning at this moment. On last Wednesday, the Fed is set to raise its benchmark interest rates, which affects many consumer and business loans, by as much as 0.75 percentage point. That would be the Fed's largest rate hike since 1994. World Cup was in 1994, and this year we have a World Cup again. And it could herald the start of a period of especially aggressive credit tightening by the central bank, and with it, a higher risk of inflation. So basically what they're saying is the Fed will charge more for money. So banks will borrow less from Fed and will have less money to borrow to the regular people. So when everything like this happen, people tend to protect. That's why people are selling their stock. We come along from almost 12 years of a bullish market. Of course, at some point the market was going to go down. People are just cashing their profits. Once they're cashing their profit, they need to choose what to do. They have a couple of options other than the stock prices, the stock market, and now the new cryptocurrency market. Basically, they need to decide, will I leave this money at the bank without doing anything? Will I spend this money, or will I invest in something else? If they leave the money in the bank, they're not going to get a lot of money for it, and they're going to lose 8% to inflation. So I see a lot of people saying, I'm sitting on cash. I'm sitting on cash, because you are stupid. If you are sitting on cash, you are losing 8% every single year on a daily basis. So don't sit on cash. If you sold your stock because the stocks are not going up, if you sold your crypto because the crypto are crumbling down, use your money to invest in something else, such as real estate. That's how people defend their positions. If you look all the recessions in 1981, in 1989, 1992, 1999, 2000, 2008, in all of the last recessions, prices of rents went up. In all of recessions that America had since 1981, prices of rents went up above inflation. And the only recession that the prices of real estate as a whole in America, residential real estate, didn't went up was in 2008, and that's because it was created by the real estate market, which is not what is happening right now. The real estate market is not creating the boom in the economy. The real estate market right now is a consequence of what is happening in the economy. People start investing more. People had money. People were afraid of COVID, start changing their house, upgrading their house, because now they're working from home. They start moving around the country, moving around the world. Here in Florida especially, people moved here and prices went up. So real estate's not causing the boom. Is the economy, is the reflection of the economy that is bringing a boom for the real estate. So you need to pay attention on that. The Fed rose the interest rates. Inflation will continue to be high, and real estate is a good place to park your money. If you're saying, I'm sitting in cash, you are dumb. Let's go to the next one. Mortgage rates, highest weekly jump in 35 years. The rate for 30 years fixed mortgage jumped over 0.5 percentage point in 1 week, from an average from 5.23 to 5.78. Of course, if the banks are being charged more by the Fed, they will charge more from you. They need to hedge. That's why mortgage rates went up. Now it's 5.78%. Daniel, but what is going to be the reflection of this in real estate? My opinion, not that much. Of course, this will slow down because the average Joe will not qualify anymore, or he will qualify for a cheaper property. Why? Because with a higher interest rate, his payment is higher, so he can finance less. However, 38% of homes in America are paid for, are debt-free. They don't have a mortgage. If you remember in 2008, that's another point. And from the ones that has a mortgage right now, I guess 50% has fixed in 2.2% or lower. Between 2002 and 2008, the subprime, they had a line of credit where you paid interest only for 5 years. And after 5 years, you start to pay the principal and the interest rates. The problem was that the interest rates were not fixed. That means that if the interest rates went up, the mortgage rates were also went up. So imagine you getting a loan with interest rates, a mortgage rate of 1%, and you pay that for 5 years. And when you need to start to pay the interest rates and the principal, the interest rates are now 5. So now your interest rates, or the interest that you're paying, is 5 times more on an annual basis. So that's why a lot of people say, okay, now I cannot pay this. This house doesn't worth that because I can rent for much less. Bank, here's the house, I'm getting out. That's not happening right now. 38% of the homes are paid for. Most of the mortgages are fixed with a very, very, very low interest rate. So that's not going to happen with the market right now. So I think that yes, the increase of the interest rates will slow down the market, but that doesn't mean that the market is going down because of that. Actually, you as a buyer will cry less trying to buy a house. It will be possible for you to see 3 houses, 4 houses, 5 houses before you make a decision, because since the market is going to slow down, you are going to have more time to make your decision. Let's go to the next one. Why beer is so damn good. May housing starts drop more than 14%. And that's another point. This weekend I was in a boat with my friends and this girl said, we are going to wait to buy a house because right now the inventory is very low and the future is going to be very high and the prices are going to go down. No, it will not, because I'm going to give you a few examples why that is false. Number one, here says May housing starts drop more than 14%. New construction drops more than 14%. So if there's less construction going on, how the inventory is going to go up? Tell me how. It's impossible. Less houses being built, that will pressure the inventory to stay low. Number two, buildings like they are happening here in Miami. A lot of new constructions going on. It takes 4 years to build a building. It takes 5 years to build a building, depending on the size of the building. We have Waldorf Astoria with 100 freaking floors. They're not going to start building everything, and tomorrow everybody's going to just pour the market or inflate the market with a lot of properties. That's not going to happen this year, next year, the year before, or the other one. It will take 5 years for that construction to be ready. So less construction, there is no way the inventory will go up. And I have a very hard time saying inventory because in my mind it's inventory, but it's inventory. I understand. Second reason, because interest rates are high, the average Joe that has his house with a fixed mortgage at 2%, why the hell he's going to sell his house right now to buy something else which is super expensive with a higher interest rate? He's just not going to do that. Usually that's what people do. They buy a house, they live in that house for 5 to 10 years, they pay their mortgage for that period, they have a big equity, they created or they built equity in that house, so now they have more money. What they do, they sell the house, they have the money, the balance from what they own of the house to the price that they sell the house, they put a down payment on a better house and they move to a bigger house. But why they would do this right now if the house that they live in is completely fine and the interest rates that they have there is 2%, and if they buy something right now is going to be 5.5% or 5.8%. So there is less resales on the market. So if I have less construction and less resales, how the inventory will go up? That's impossible. And that's why I already told you in those 3 news that inflation will help. Inflation makes people invest in real estate to protect their assets. Interest rates will not affect the market that much because it's going to slow down. Yes. It's going to bring down the market. No. And inventory, it's still going to be low. So how can the prices of real estate collapse If more people is going to buy, or a lot of people are going to still buy real estate to protect from inflation, the interest rates are not going to affect that much, and the inventory is still low. So unfortunately, I don't see the market going down for you that are waiting, but it's going to slow down for you that want to buy. So you won't have to cry to your realtor anymore, because now you're going to be able to send decent offers to buy the house. However, on the commercial side, things are a little bit different. Why? When I say commercial, I say residential commercial, which are multifamily properties with 5 or more units. Multifamily properties, because they are commercial properties, people buy for investment because they want to collect rent. Usually they do that with leverage. What is leverage? Borrowing money from the bank to buy that. And why they do that? Because usually the interest rates on the loan are lower than the cap rate, the capitalization rate, the return that I have in that property. Meaning, I borrow from the bank $1 million at a 3% rate to buy a property that gives me 5 or 6% return. That's golden. I have 3% cost and I have 6% return. I'm going to buy that property. I'm going to rent it out. I'm going to make some renovation. I'm going to increase the rate. I'm going to sell that property with a profit, and I will pay the bank. That's what people do on multi-family investing. However, right now, with 5% interest rates, it's more difficult to have projects that return that kind of return, that exceeds that interest rates. That's what we call negative leverage, when the cost of the money is higher than return that we have for the multifamily property. So that's slowing down the market for multifamily. So if you have a multifamily, don't wait too much to sell, because once the interest rates go higher, it's going to be more difficult for people to borrow money from the bank to buy you out, which means that you're going to have less demand and potentially you're going to have a lower price on your commercial property. However, if you own a multifamily, or if you want to invest in a multifamily, this is also a great time, because as I said in the beginning of this video, in all recessions, the rental price in America went up. I'm going to repeat for the people in the back. In all recessions since 1981, the prices of rentals went up more than inflation. So it's a great asset to buy to protect from inflation. The cost is high, yes. If you can buy cash, because if the cost of borrowing the money is higher than the return, that math doesn't match. So you need to have a lower cost than the return. However, if you can invest in a multi-family property, do it now, because recession is good for real estate. So this was our real estate news for the week. I got some of the most interesting news that I saw this week, and I brought it here to you, drinking my Stella Artois. Stella, if you want to sponsor me, I'm very cheap at this moment. So yeah, we can make a good deal. See you next week.